Hello, everyone, and welcome to today's webinar, Are You Credit Ready? I'm Andrea Frost, and I'll be your moderator. I'm part of the communications team here at the Capital Masters, and I'm excited to be hosting this session. We've got two brilliant panelists coming up. Bob Hernandez is the Treasury, Credit, and Finance Wizard here at the Capital Masters. Over the course of his career, Bob has analyzed and contributed to the closing of approximately $400 million in small business loans. And Rich Rosikoff is the acclaimed author of Make Banks Compete to Lend You Money, the definitive guide to creating a dynamic narrative and top-notch business plan that gives banks what they need to say yes. Together, this experienced team is going to discuss what you need to know and do before you approach banks for funding. Before I hand the mic over to our two experts, though, I have a couple of housekeeping items to cover. First, today's webinar is being recorded and it will be available on demand after the live session. Once the webinar is concluded, we'll email you a link so that you can access the recording at any time. Also, we'd love to hear from you during today's presentation. If you have a question for our speakers, please feel free to send it through the Q&A tab at the bottom of your viewing window. We'll save the questions for the end of the session. And if we don't get to yours during today's webinar, we'll be sure to follow up afterwards. And finally, Bob has a special guest with him today, Mr. D. Edward Deals, who will help illustrate the consequences of being unprepared when approaching a bank. So without any further ado, I'd like to kick things off to you, Rich, Bob, and Mr. Deals. It's all yours.
Well, thank you. Bob, let's just take a minute to talk about why we decided to do a program called Are You Credit Ready? And it's by credit ready, we mean, have you covered all your bases that the bank will need in order to say yes? And we're going to share with you some insights today that you won't get anywhere else, because we're going to give you what's going on in the back room as opposed to just what the credit loan officer might tell you. Let's go to the next slide. So Bob, aren't all banks the same? If one bank says yes, doesn't that mean 10 will? If one bank says no, doesn't that mean kaput? Nobody wants your loan?
Rich, are you and I the same? Am I the same as Andrea? No. All banks are different. Every bank has its own DNA. Every bank has what I call its own balance sheet. They all maybe follow the same fundamental rules of analysis and sales, marketing, credit, but the way they perform it is going to be unique to themselves. So the answer is no.
Okay. And some of the reasons may be, so often banks are merging, and during a merger, they're very careful what may go into a portfolio, or a bank may have a distaste for an industry that another bank really wants to go with, or it may well be the size of the bank, which determines whether they can say yes or no.
Yeah, it can be numerous reasons. I mean, there's literally hundreds of permutations of what can cause that. I mean, they could have had a restaurant loan that went bad 10 years ago, and the chief credit officer that has been there that whole time remembered it, and he has put the kibosh on all restaurant loans. It could be that their portfolio is super saturated in a specific industry and predicated on regulatory requirements from the FDIC. They're not allowed to have any more of that kind of loan. Or maybe a certain segment of their portfolio has been downgraded in their credit due to maybe COVID or some other anomaly. So there's many, many reasons out there.
Which is why it's so important to shop and also do your homework about the banks you're shopping with so you have an understanding of where they are. Bob, I don't want to put too much more time into this, but where's the best place for me to look to see how healthy a bank is that I'm looking to do business with?
I mean, you can go to bankrate.com, you can go to Bloomberg, you can go to the Wall Street Journal. I mean, there's literally tons of resources on Google. You can go to the bank's website, go to their legal page. You know, if they're a public entity, you can get their 10K or their 10Q and read that. Everything's going to be there because it has to be. So if you have that level of education where you can understand a document like that, then by all means, I would do that.
Thanks, Bob. Let's go to the next slide. Now, when we say, can you articulate to the bank, we're not talking about a 30-second elevator speech. We're talking about understanding what it is that you are presenting to the bank in a clear and concise way, so that they know you're not saying, well, here's my financial statement, how much can you lend me? That will scare a bank away faster than anything else. So what are the key things you need to be going in there to communicate effectively to the bank that you probably want to role play before you do it?
Well, some of the things you don't want to do, like you mentioned there, one thing that I've heard continually in my career is, hey, Mr. Hernandez, I have a 823 credit score. I want a $500,000 loan. What's the rate? And I go, what? Bye. No, what you need to be able to do is tell them, you know, the who, what, when, where, why, you know, who you are, why you're here, what the business project is, you know, what it's going to cost, what the components of it are, any industry risk related items, what sort of money you're willing to put down into the deal, and how the bank's going to be paid back, and what's going to make them secure and comfortable, such as possibly collateral. Now, not all loans have to be collateral based, but you get the general idea, Rich.
Yeah, we'll get to that. And the big one that you said, Bob, and you repeatedly tell me when we talk about this, is the how. How are you going to pay it back?
Yeah, the banks generally want to know 3 levels of being repaid, and that's cash flow from operations, that's guarantor support, meaning if the cash flow from operations is insufficient, they're going to pull a judgment or sue the guarantor, or at the end, foreclosure of collateral if there is any.
And we'll talk more about collateral and things like that in a few minutes. Next slide, please, Lucy. So this is, we get into the 5 C's of credit. And most people don't know the depth of what a bank will look for when they look at each one of these C's and why it's critically important. Bob, do you want to talk about this one?
No.
All right, then why don't you anyway?
Yeah, a dead deal back here was kind of poking me. Yeah, we don't really care about that, Bob. But actually they do. How liquid I need to be translates into a term bankers use called liquidity, which is really, what instruments do I have that can be converted to pure cash within 90 days or less? So generally what the bank is looking at is checking accounts, personal, business, savings accounts. They may look at cash value of life insurance, 401ks, IRAs, but primarily they're looking at cash on hand. And they want to know, can you make the down payment? And on top of that, do you have enough reserves? For example, you're doing a small construction project for a franchise, and you might be working on the project for 6 months prior to opening. Do you have the reserves to pay your own bills? And so they're going to look at that as part of the process, and they're going to prove it, because with the Patriot Act of the United States, which came from 9/11, all sources of cash have to be proven.
One of the things that we just discovered, a client that I'm working with on my coaching side just was turned down by a bank because they've had a terrible last quarter as a result of the virus. And that's a tough time to go to the bank because it also depleted their reserves. So you need to be aware of that when you're going out there, because that's going to get you a very quick no.
Right, and banks tend to call those story credits. there's a story behind the situation.
Yes. Next slide. So there's a couple ways a bank will assess character. And one of them is a document they're going to want you to fill out. And the other one is your credit scores. And what I get to look at when I look at my credit score is not nearly as in depth of what a bank will be able to look at to go really deep with your credit. And it's really not a credit score. That's a misnomer. It's credit history and currently how credit worthy you are. But Bob, what are some of the other things that a bank will look for? I've got an 800 score. Shouldn't I be solid?
Yeah, you're great, Rich. Man, hey, wait a minute. There's a judgment on here from 15 years ago.
Oh, that.
You defaulted on a car loan and it didn't affect your score because it's that old, but it's not going to allow any bank to perfect a security interest into its collateral because of that, and you have to pay it off. So, you know, banks will be looking for rogue judgments out there. You could have had a bankruptcy where you have an 830 credit score, your report's beautiful and clean, and then the bank does some more due diligence and you just came off of Chapter 7, where you essentially gave the shaft to every bank and creditor you had. Your deal's dead. It could show that you're in default of child support payments. Deadbeats don't get loans. It could show maybe there's other legal things going on. So within the credit report databases, there's up to 300 items that if somebody chose who can access those, like a bank wanted to get, they could get. So the banker, the credit officer, credit analyst is going to really delve deep into your report. If they see on the first couple of pages in the summary that there's no lates, there's no anomalies, there's no legal issues, they might close it there. But if not, they're going to delve deep into the report, and they might even be crunching ratios of what your debt is compared to what you make.
I was working with a client in 2008, and in 2007, we were ready to go for the loan, and then we looked at his credit score, and there were so many dings on it. Fortunately, we were able to clear them up, but it took time. It took a year to clear them up, and we, when we presented our document, we let the bank know what happened, what this was, how we've been able to pull this back up, and how we're clean now. So we were able to take the red flag, take care of what needed to be taken care of, and then make the bank comfortable.
Yeah, inquiries are another big thing. If a bank goes to the last page and sees 25 inquiries, they're going to know that you're shopping the heck out of your loan because of all those hits to your credit report, and they're going to pass. They're not going to give you the time of day. So inquiries, most banks don't want to see more than, 3 or 4 in a given year.
So what you have to do is you have to be very careful there. We were going for a refinancing, and somebody told us what the deal was. We let them do a hard credit on us, and turned out that they weren't telling us the truth, but the hard credit stayed on our report for a year. Bob, how about if I'm a foreigner? Where's that? How does that fall under character, and where does the bank find that out, and how does that impact what circumstances I can and can't get a loan?
Yeah, from a foreign standpoint, if you have a green card and you have an existing business here, you're paying taxes, you're SBA eligible. There are certain things, EB2 visas, business working permits, things like that, that you're not allowed to secure an SBA loan for. And you may have in the past, but the rules have changed on that. But for a commercial bank, which is a totally different process, underwriting, credit, everything else, you may still be eligible. I've looked at, loans for cross-border individuals and people from other countries several times in my career. to do business here. And there are, banks. I'm in Texas, and there's a lot of business between Mexico and the U.S. here, and that's allowed, but not necessarily for an SBA deal. And there's a form, if you are going for an SBA, that the bank will have you fill out, that everybody fills out, called a 1919, and it will address your status on that form.
Thanks, Bob. Let's go to your favorite subject, collateral. So what's, again,
wait a minute. Wait a minute.
Okay.
D. Edward was just asking me that he would rather do deals that had gold as collateral. And that's not right.
Okay. Well,
anyway, go ahead, Rich. I'm sorry. I got interrupted by a stack of bones.
But you're as good as gold, Bob. So
that's true, but not in my teeth.
Okay. So, and if they were, you couldn't use them as collateral, could you?
Exactly. I don't wear a grill. Yeah.
So what are we talking about? Sufficient collateral for a loan. And let's again describe the difference between collateral and liquidity.
Yeah, collateral and liquidity have not a darn thing to do with each other. Liquidity is cash. That's down payment. That's money in the bank. Collateral is security. It's comfort. It's chicken soup for a banker. If this loan defaults, I'm okay. I can take the widow's house. Or, sorry, old reference there. Wizard of Oz, maybe. But no, collateral is going to be hard real estate. It's going to be hard assets that can be quickly converted to cash to pay off a loan that has gone bad. So they're two different things.
My first loan on the Outer Banks of North Carolina, banker said, "What do you have for collateral?" I didn't even know what the word meant. And I said, "I have $3,000 in inventory." He said, "You don't have collateral. However, by doing an SBA loan with the SBA guaranteed portion of it, they were able to do the deal." So can you explain why that would be?
I'm sorry, Edward was talking to me. Repeat that last part again.
Okay, so the SBA component gave the bank the comfort that they were covered for up to 85% of the loan if I defaulted.
Yeah, that's not collateral. What that is the SBA is giving the bank comfort that if the loan goes into default, they will cover the loan. It is not collateral. And in all reality, the bank never wants that to happen, because if they have to go back to the SBA to recoup the guarantee, they get a big black mark. And the auditors are going to be on their doorstep coming to look at their portfolio. Nowadays, maybe that's laxed up with COVID, but the SBA guarantee, it's a strength that you can put on your credit approval memo to the credit authority, but it is not a reason to do a loan.
So one last thing on this one. Thanks, Bob, for the clarification. Life insurance. Many of the loans I've been able to get from my clients required life insurance. Sometimes we didn't know it till the 11th hour, and my clients would have to do a physical, and we would lose about a week to 10 days. How often is life insurance required on a deal to give the bank a comfort level?
Yeah, there's no percentage, because every deal, as I've stated in the past, has its own DNA. So where it does come into play is if there's a shortfall in collateral, then whatever that shortfall is, the credit analyst may use a calculation to determine how much life insurance may be required. If the bank's 50% secured on the loan, with maybe a second lien on somebody's house or vacation, or a first on their vacation property, but they're about 150, 200,000 short, maybe they have the guarantor get a life insurance policy payable to the bank for that amount. And that shores up the difference in collateral value. Okay,
so let's move on to the next C, which is conditions, which more than ever before is with with COVID and so many businesses and industries being affected, this is one of the first places a bank will go to right now. And they will actually do reports on your industry before they do anything else. Bob, can you explain what we're talking about by conditions, and how can you mitigate conditions in a time when your business may have been hurt by the virus?
Yeah, you can't mitigate conditions in a downturn industry, but what you can mitigate is how you are responding to that within your business. The industry is the industry. You have no power there, period. So what you should be armed with going into the bank is knowledge of the industry and knowledge at your asset size of how you fit into the industry at that level, and how you're going to be able to mitigate or have more strengths and weaknesses, the risk inherent in that industry, and demonstrate them to the bank and have that incorporated into how you're using your funds for the loan.
And another example within an industry of where you are, we just finished a loan package that we're about to shop for a client, and he's in the food industry. They've got a lot of restaurants, they've got a lot of franchises. However, their primary focus is on pizza. And Bob, you got the riff on why pizza is a good place to be right now, as it's always been.
Yeah, just briefly, because I know we're running short on time. On the pizza world, they've always been delivery. They've always had takeout, and in COVID, that's key.
And if you're Instacart or in a position like that, this is prime time for you. So yeah, it all depends on how the industry is impacted and how it impacts you as well. Let's go on to capacity. So that gets back to, can you repay the loan? Can you repay the loan? Can you repay the loan? So how do I show the bank that I do have the capacity, Bob?
You show them by showing your historical tax returns, your current profit and loss and balance sheets, receivables payable reports, and that you understand and know everything in those reports. If you don't, then you have your financial man or woman with you, CFO, treasury person, whatever, bookkeeper, CPA, there alongside to articulate all that to the banker. You have to be able to account for any variances in sales, revenues, changes in cost of goods sold, salaries, draws, expenses.
And Bob, I think it's always a good idea if you have a good financial person who has who is articulate, to be side by side with you and answer these questions. I think it enhances your ability to get the loan, and it gives the bank comfort that they can go to this person for the financial information. For example, one of the clients we're working with right now, the number 2 man in the company knows all the numbers, and the bank that's looking to make this loan goes directly to him throughout the process.
Yeah, when I was a credit analyst with Chemical Bank New York, I typically wouldn't talk to the CEO. They would send me, they meaning my boss at the time, would send me directly to the controller or the chief financial officer, and I would be in an office with him or her for several hours, several times, asking all the questions. So yes.
So leverage that person, and if you don't have them and your accountant is savvy and won't hurt you, you may want your accountant to take part in your meetings with banks. And even if they're just on a Zoom call these days, I think that can be helpful. Let's go to the questions now that we promised we would answer. Now, Bob, you just talked about this, capacity and knowing your numbers. Can I explain them? And what we've seen is, in so many cases, things change. And how does that impact a bank when your cost of goods and your operating expenses and your revenues go up and down from year to year.
Well, you don't want to be presenting a roller coaster case, and if you do, you're going to need to be able to really explain why that is, because it's going to show that, one, either you don't know how to run your company very well, or there's a lot of inherent industry fluctuations. Maybe there's seasonality. Maybe that's why it's like that. But generally, banks are looking for companies where revenues and cost are stable. They may be growing. So cost of goods sold might be low one year, bigger the next year, but the common size percentage of the amount stays the same. So if you have severe fluctuations or downturns, that's going to be an issue, and it's going to be looked at. It's going to be scrutinized, and it could be the reason for D. Edward here to be talking to you.
So one of the clients that we're working with in 2018, their business was $100,000 more in revenue than 2019. However, their profitability in 2019 was much greater. And what we said to the bank was, well, that's because we chose to go after the sweet spot in terms of cost of goods and best clients. So we fired some clients and went deeper with the clients that gave us the greatest return. And that's our strategy for moving forward. And we're concerned with bottom line profits. So let's go to the next slide.
Yeah, this is a big one. If you're asking money from the bank, or trying to get money from the bank, and it's on a future basis, it's not like you're doing a refinance or maybe a business purchase, but you're trying to build something, you're coming into a new business. Your projections have to be reasonable. You can't show that in year one, say and I use the word franchise just because I've seen a lot of those lately. You're a franchise and you project you're going to do $2 million out of the gate for a ABC hamburger franchise. It's just not going to happen. The bank's going to look at those and just either throw them in the trash or start laughing. So you need to be reasonable with your numbers. You need to have a best case and a base case, and your assumptions have to be credible. You have to back them up with demographic reports, with analysis of maybe other similar stores within your industry. Real data is required.
So when we were going through one of the packages, you wanted them to say, okay, my rent is $15,000 a month. You wanted to be able, in the assumptions, to say in the exhibit is the lease, that $15,000 a month is for the next couple of years. It's net, 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 or whatever it might be. And that's something I think most entrepreneurs wouldn't even think would be significant to put in the assumptions.
Yeah, have you assumed any CAM charges, escalation charges? CAM is common area maintenance. You need to put all that stuff in, because generally a bank wants to see 3 years, no more, because it's just kind of, wags beyond that. But even interest on other loans, have you calculated amortization schedules to put the correct interest in there? The bank will.
So the bank's going to ask the questions regardless. And if you go into them with a detailed list of your assumptions and what they stand for, you're going to really show the bank that you understand it, you know what they want, and it'll give them a comfort level.
Yeah, the main thing to take away here is if you make a statement of any kind in any one of these sections or scenarios, you need to be able to back it up with facts, because blue sky and words do not repay debt.
Yep. I have a dream doesn't cut it.
Nope.
Let's go to the next one.
Yeah, this is quick. This is for all those individuals who maybe they're say, you're a scientist or you're a programmer, and you've been sitting at your desk for 20 years and you want to go open up a hotel or a restaurant or something. that's probably not going to fly with a bank because it's a whole different modality. And from sitting at a desk and having secretaries and assistants to being on your feet 14 hours a day for the first couple of years, you know, you're going to need to have a general manager or somebody there with experience to be a partner with you into that deal.
I think one of the things I've learned banks look for is when they assess who you are you the visionary? Are you the marketing person? Are you the financial person? And once they put you in a box, you need to be able to show that you have the team that complements your area of skills and expertise. Because in each one of those areas, even if you are the ultimate financial guy, the bank might be concerned, okay, you know how to manage the numbers. Do you know how to make a business grow? So those are things to be aware of. And that's why I think it's critical in your package and in your presentations that you be able to show the complementary staff and team you have and the depth. I helped a client get a loan, and they had 30 people working for them that were IT specialists. We put in the package 30 pages of who these guys were and gals, what their experience was. And we said, this is the most important thing we have to offer to market. We have terrific, talented people, and that's why customers come back to us.
How we doing on time, Andrea?
Guys, you're doing well. We definitely want to leave some room on questions, to ask a few questions at the end, but I'd say you've probably got about at least another 5 or 6 more minutes where you can tackle that last question.
Yeah, if my take on Rich's stuff, and we're kind of different real quick before we go to that, is if you're going to give a bank 30 pages of personnel stuff, it's probably not going to be read. So if you're in front of the banker and you're discussing that, that's probably the best place to do it. The other thing is, if you are going to do that, you better have the word skills to be able to properly do it and incorporate it into your presentation. It's not for the weak of heart. Well, my loan presentations are typically 10 to 15 pages long with exhibits. Since I've been with Rich, they're a lot larger because we're combining our forces. But for Joe individual going out there, be cautious of what you're presenting and how you're bringing it in. And if you're going to go for the Bob and Rich show, you really need to know what you're doing.
Yeah, and what I don't expect the banker to read 30 resumes. What I expect is, if we're pre-COVID, we're in front of the banker, I want them to be able to flip through that and
Correct.
just be, wow. Some of the things that I want to put in the package, I never assume will be read. I want them to be scanned, and I want them to give the bank the impression that this is a hell of a staff. This is talented people, because we're not selling widgets. We're selling services. So do we have the right team to sell our services? So that's where I think the difference comes in your approach and mine. And we're working it through to be able to have the best of both worlds.
And it's worked for both of us over time individually. So it's kind of cool to do this. So what's that next question on the slides?
This is a question that Bob, if I say to you, hey, not a problem, I don't have any competition, what do you think? Do you think, well, is this guy lucky?
Yeah, I go back to the 1970 Saturday Night Live. Jane, you ignorant, and something to that effect. Basically, you never tell a banker that you don't have competition unless you just created something from an off-world planet. Everybody has competition. Everybody does. So know your competition, understand who it is, even if it's weak, even if it's second tier, you're going to have competition. And you need to know who it is. You need to know it's art of war. Know your enemy, and your competition in some courts is your enemy. They're going to take sales from you.
So we're working with a client who is in the AV industry, and there are 8 players in the market. And in each case, we gave the logo, we gave the history, and we gave the focus of the client. And then when we talked about us relative to the competition, we were able to say where we have the competitive advantage and where in some cases, the people that are competing against us hire our services to do things that they can't. And that really creates the big picture for the bank. I was working with a client years ago who was in the natural foods business, and this was in Richmond, Virginia. And a major natural food store came into the market. And we put in the package who they were, how excited we were they were coming in, because natural foods was just new in the marketplace, and they had a significant advertising budget, and they were going to promote natural foods, and we could piggyback on it. So how do you leverage your competition? How do you show where you're nimble and recognize that if you're in the restaurant business and you're selling pizza and there are 15 other restaurants in the area, whether they're selling Chinese food, Indian food, or steaks, it's still competing for the dollar of people going to eat out.
The banks call those generators, and they're there to provide choice. So if Rich, Andre, and I were out for a business lunch and we went to that area, we go, well, do we want to eat hamburgers? Do we want to eat pizza? Do we want Chinese food? What seafood? What do we want here? We have choice. So generators, from a competitive standpoint, aren't necessarily bad. They're good because they provide choice for people at a given time and moment. But if you can articulate to the banker, yeah, that Asian restaurant next to us, they're doing $45,000 a week in sales. They have 2 day parts and they have a drive-through. That pizza place over there is doing $52,000 a week. They only have 1 day part, and they have 50% dine-in. And the hamburger place is doing $12,000. Man, that's going to blow the banker's socks off, to use a rich term.
Yeah.
That you really know your competition and you did your research, and you can find all that out. It's
One
out there.
of the clients we're working with right now are opening up 2 different franchises right next door to each other. And one focuses on pizza and casual dining. The other one is a burger place. And the reason they're doing it is because they believe they will complement one another. Anything you want to add to that, Roberto, before we go?
No, I'd rather get some questions. I'm sure that there's some out there. We've talked enough.
You are indeed right. We have some really excellent questions today. And let's start off with one that I think is probably on a lot of people's minds, which is, how many banks would you recommend approaching?
Bob and I have a different philosophy on that.
Yeah, we're diametrically apart on that, but we'll give you each of ours.
Yes, and then you can decide what you want. Bob, you want to go first?
I use the rifle approach because in my mind, if too many banks find out that you're out there shopping, you've killed your deal on the front end. But my banks are more nationwide, and by my banks, I mean there's individuals at those banks that I've either worked with, were credit analysts or officers along my side, or maybe I manage. So I know what their philosophy is, what they like, what they don't like. So when I see a deal, I'm able to go, it fits this bank better than that bank. And I go there and I know within a fairly high probability, not 100% by any means, but greater than say 60 to 70% that it's going to get done.
Well,
So I'm rifle approach.
in one of the deals we're doing right now, Bob knew 3 banks that they thought would be very interested in this. 2 of them were, one of them passed, and ultimately another one passed. So the good news is we have a bank that it looks like they're going to close in 2 weeks. The bad news is if they don't, then we're back to square one.
Yeah, let me make a correction there. Not close in 2 weeks. Obtain a commitment letter.
Yes, that's what I meant. The commitment letter. So my approach is shop till you drop. And once you put the package together, all you have to do is shop. And whereas Bob is concerned about other banks seeing that they're competing against you, my experience is I want the bank that's going in to meet with us, see the bank that's leaving. I want to be able to say to the banks, we are looking for the right bank to establish a long-term relationship with. Please tell us why it should be you. And then ideally, you have 3 banks that express an interest. And then you can say, well, I like this. This other bank isn't asking me to do this. Can you make a change here? And ultimately, that's how we get our best deal. Also, I've been in situations where we picked the bank we liked. We loved them. We were ready to close with them. And then we got a call saying we're merging and this won't fit into our portfolio. So we went to bank number 2 and we said, you've got 48 hours to tell us if you like this, or we're going to go to bank number 3. So I believe banks are like, they're not a commodity. You want to find the best one for you. And the best way to do it is to shop. And the best way to shop is to get recommendations, testimonials, people that know the bank to let you come in. And what I found is when I've gone back to banks in a marketplace, even though they didn't get the first deal, they appreciate that I'm coming back to them. So it's worked for me in the way I do it, and the way Bob does it works for Bob. We both get the deals.
And
next question, Andrea.
Yeah, well, actually, I was going to say, as the communication strategist whose job is to merge Bob and Rich's comments, viewpoints, and strategies, that I will say that there's merit in both approaches. When you're working with national banks, that rifle approach is good. When you're maybe approaching more of the community banks that are more possibly more hungry for business, then having them compete is a great idea. Okay, gentlemen. Bob, this question is actually for your colleague there. I understand that Edward likes to be called Ed. So for Mr. Dead Deals question there, Edward Deals, Mr. Dead Deals, what are the biggest mistakes that people make when they're approaching banks?
They should already have the money. They didn't ask their grandma. No, Edward, that doesn't work. Yeah, what Edward was just joking. Some of the biggest mistakes that people make are very simple. They're just not prepared. They're coming into the bank with nothing other than, hey, I have an idea and I need money. Well, why? Well, because I need the money. Or they have a bankruptcy, or they have something in their background that I know is going to get uncovered, and it gets covered up early and they're booted out of the bank. Poor credit, lack of knowledge, or if they present a loan package, somebody else prepared the numbers for them, and they can't articulate or explain any of them, and they kind of look like a buffoon.
Right. They may not be right. I see over and over again on the way to the bank, someone picks up their latest P&L and balance sheet from the bank, and all from the accountant, and all the accountant did was spit out numbers that were presented to them, and they're misrepresenting what the client is really doing. And the first person to notice it is the banker.
Or they're going out for a line of credit when they really need a term loan. They don't know, and that's a whole nother video regarding the capital stack and knowing what your allocation of funds should be, is they're going in for the wrong type of deal.
All right. Though this question actually ties in a little bit with that, which is, I don't have a financial person who can present well to the bank. What are my other options?
You're looking at them.
Yeah.
Go ahead, Rich.
When we're making presentations to banks on Zoom these days, it's amazing how many questions gravitate to Bob, because Bob speaks their language. Bob thoroughly understands all the financial information. He knows what they want and gives them a great deal of confidence. When we're talking about marketing, when we're talking about growth, when we're talking about the industry, the vision, that's where the CEO should shine. But I think it's essential that if you're not strong there, you find someone that can represent you that can be. And that's something we can offer, by the way. We can help you there in terms of me from the strategic standpoint and Bob from the financial standpoint. He not only talks the bank's language, he's walked the bank's language.
Yeah, I've been a banker for 39 years, and you know, Rich likes to focus a lot on the numbers, and it's kind of an inside joke with us, but it's not only numbers that I'm fluent in, it's federal regulations, bank regulations, credit analysis, industry analysis, and everything that goes with that. The numbers are ancillary to all of that. You have to understand the whole ball of wax in order to be able to fully present to a banker or another credit officer.
And I've learned so much. I've learned so much from Bob as he assesses a deal and he looks at what he needs. And he introduced terms to me like ratios that had to do with what a bank is going to look for by way of a ratio of the cash flow you have and the loan itself to determine if this is a right fit. Could you just explain in 90 seconds or less, Bob, what that means? Because this is such an important understanding for an entrepreneur, because if you don't know that, you may be wasting your time.
Well, thanks, Rich. You just left me 15 seconds. Basically, what he's talking about is the debt service coverage ratio, which is how the bank determines you have adequate cash flow to repay the loan. And that's all that is your cash flow, which is earnings before interest, taxes, depreciation, amortization over the principal and interest payment. Very simple ratio.
We're good on time, Bob. Andrea?
Yes, I was actually, I was going to reference back to the previous question, because as someone who actually puts together the packages, based on the information that the two of you gather, Bob and his review of the numbers and regulations can save time for people who are taking the wrong approach, whereas Rich, you getting to the depth of the story and making sure that the package looks good has always helped clients put their best foot forward. I believe you both have said, you know, how a package looks is reflective of your work ethic and how you run your business. And with that said, that's actually another question here that we've got, which is what should be included in that loan application package?
Yeah, go for it, Rich.
All right. Well, let's, first of all, I want to go back to what Andrea just said and what a package looks like, how professional it is. There's a great Zen saying, your spirit shows in everything you do. And the first thing a package needs is a solid executive summary. It's concentrated orange juice. This is who we are. This is what we're looking for. This is how we're growing. This is our place in the market. This is all be explained in the package, followed by, and I'm going to let Bob jump in on the next one, and then I'll come back.
Yeah, generally, just to abbreviate it, you have your executive summary, then you have a sources of uses of how you're going to use the money, and that's going to come in from the bank. Then you have a historical analysis of how that's going to be paid back. Then you have a collateral analysis of what you're offering to the bank for security and comfort. You have a management analysis of who's running the company, what their responsibilities are, who the guarantors are, what kind of strengths and weaknesses they have, what they have in the bank, credit, things like that. Then you may get into employees and staffing. You get into industry, competition, and then strengths and weaknesses, and a closing summary, and your exhibits, which are all your tax returns, financials, maybe construction budgets, maps, competition maps, news articles, things like that.
A couple things I would add to that. It's very helpful to have a page or two of milestones. Business was founded in 2008. We did 400,000 that year. 2009, we got a major contract and we kicked us to $1.2 million. 2010, we hired an operations director and moved to a new location. In 2011, we redid our branding and we were up to $4 million in sales. In 2012, we moved to yet another location and we added another product or service. Going through that very quickly and letting them see the evolution of your growth is critical. Another piece is sales and marketing. How are you marketing your business? Are you on social media? How do you reach your clients? How do your clients find out about you? What's your mix of products and services? What are your cash cows? Who are the strategic partners that you're working with? Who are the professionals that are on your team? And Bob thinks it's important. Who's your lawyer? Who's your accountant? Who are the key professional players? And when we do a package, we put Bob in as the treasury officer and me in as the strategic partner for a company, not partner, but strategic analysis. And we do that because banks like to see you're not doing this alone. You have great talent and you have a great advisory team. So those are the key things that go into a package. And if you are interested, we've developed a template, and just let us know, and we can probably send you the template for a loan package. Andrea, do you want to take a minute to address that? I think we have time.
Yeah, actually, I was going to say you kind of threw me a softball over the plate talking about marketing and how people know about you. If you look at the slide that's on your screen, the Capital Masters does have its own website, and we really believe in working with our entrepreneurs, and we really want to see everyone be successful. And to do that, we have put together a huge collection of resources that some of them you can use on your own. We also offer webinars and Q&As every month. And there are a lot of other things you can download. I highly recommend starting with the financial glossary. It answers a lot of questions and also gives you the proper language to ask questions in so that you sound more like you know what you're doing. And that's important when it's when speaking with the banks. So you can find that at thecapitalmasters.com. And if you have other questions, you can contact us at our email address, which is social@thecapitalmasters.com. There's, like I said, plenty of resources for you to access there. And I do have another question here, which is, are there different banks you should approach based on your industry, or are they all the same?
They're all different. And yeah, there are certain banks that lend in specific industries. So yeah, it's important that you do your research to find out, who those banks are, because not all banks are going to cover every industry on earth. It just doesn't happen. And there are specialty banks.
And what we've discovered is that our banks that really like franchises, it doesn't mean they like every franchise, but they really like franchises. There are banks that specializes in golf courses. There are banks, Silicon Valley Bank established itself as the IT bank. When you ask people in the industry, the first place they think to go is there. They've done a great job of branding themselves. That doesn't mean they're the only or the best bank to get funding for IT, but it's another example.
Yeah, the banks like that are extremely conservative, so you really have to have your ducks in a row. Yeah, there are differences, and on the franchise side, banks will actually separate franchises into several tiers and grades A, B, C, and D, and they might only take certain franchises within those grades and tiers. So do your research.
That leads us actually into a great follow-up to this question, which is, where can I find that kind of information? I obviously I need to do research, but where should I go to find that information?
What information? Franchise or the banks?
The banks, and which banks specialize in which kind of lending?
Yeah, you can just go to Bankrate, go to Bloomberg, go to Hoover's. There's a lot of places like that. You can Google it.
One of the things,
some of the places that we would go to are probably, licensed places that we can go in. For me, most of that stuff's in my head because I've been doing it so long, but those are generally the easiest places to go.
well, I can go into any market and go through the phone book, go through online and see, do they do business loans? And what can I learn about the bank there? And then what I like to do is call a bank and say, hi, this is Rich Russakoff. We're representing a bank in your area. What they do is direct marketing. They have $10 million in sales. We're looking for the right bank to work with for a line of credit and also a term loan of $500,000. Would this be something your bank would consider? And what I find is, if a bank says no, the next question is, who do you recommend I contact? And Bob can tell you, every bank in a community knows what everybody else does and specialize. And sometimes that's been the best way to get to the right bank.
And by the way, Rich has a DeLorean time machine that allows him to go back and access paper documents like phone books. So that's where that comment comes from.
Well, that was then, Bob.
So gentlemen, I have one last question, because we are getting very close to time here. Having prepared a lot of these packages myself, I know that a couple of things that need to be brought to the table are good research skills, because you've got to find out what's going on in your industry, your competitors and all that. And you need to be a proficient writer if you're going to tell the story. But from your perspectives, because you each have different ones, can you just take maybe 15, 30 seconds and let us know what skills that you think are important that maybe you bring when you come into approaching a loan package?
Well, I'll start with, when we do a loan package, you get more than the loan. You've got a strategic plan. You've got a recruiting document. You've got something that you can take to vendors. You've got things you can use to market, and look at it like a Swiss Army knife. So the better the package, the more comprehensive, the more things you can do with it.
Yeah, and from my standpoint, my narrative relates to telling a story of what the historical trends are, what the numbers are saying, how this business relates to others within the industry, any pitfalls, and just, you know, giving that story in a bank credit manner to where a credit officer can really understand what's going on. They're gonna change everything I do anyway, but it gives them the basis and a path to go when they initially get the document.
Oh, thank you guys. That was a lot of fantastic information to unpack. If you've been watching this and you agree that it's a lot to unpack, don't worry, we will be sending you an email with a link so you can go back and watch these questions again and take your time so that you don't miss anything. And we just want to thank you one more time for joining us today. And again, we invite you to visit the website for some of the free resources and other tools that we have to help you when you're in your quest for finding funding and growing your business. And Bob, Rich, thank you.
Oh, and Edward too.
And Edward too.
We're here for you.